Hey, everybody. Good afternoon on a rainy Tuesday. Here it is in North Carolina. I'm visiting my mom in the great state of North Carolina in the Research Triangle Park area. So, doing this edition of the video update for the Biotech Capital Compass from North Carolina at my mom's place. It is a very kind of cold and rainy day outside. I happen to like those kind of days. I know they're not for everybody, but I do like them. I will be addressing the state of biotech again today, which is in top shape. So we'll try to keep it a little bit light and just fun, as opposed to overwhelming, which at sometimes our sector can seem to be. So let's get going. So again, welcome back to the Biotech Capital Compass. I'm your host, Hartaj Singh. And yes, despite the sound of my voice, I'm still very bullish on the sector. Actually, I think my voice does indicate I'm bullish on the sector. I do love biotech a lot, and it is an area that I'm very passionate about, both from an investing perspective and from a science perspective, and in terms of getting drugs in the hands of people, patients who really need them, and especially caregivers who work with these patients. So today we're going to cover three key stories shaping sentiment in our sector most recently. We're going to talk about the FDA's new leadership and how it's, in parentheses, surprisingly not freaking anyone out. I'm talking about companies here, especially what we did was we parsed their commentary from the first quarter earnings calls, a range of companies, and see what they were saying. Secondly, we're going to talk about short sellers piling into biotech. And then lastly, we'll return to everyone's favorite regulatory bogeyman right now, the International Reference Pricing System, or what's called the most favored nation pricing. A lot has been written about that since 2016. We've written about it. We'll talk about it again. And why we think, while it is a real bump to biotech in the short term, could be less of a problem in the long term. So let's get going. If you're an afternoon coffee kind of person, grab your cup of coffee. If you're sitting in front of a Bloomberg terminal or a FactSet terminal, get it turned on, or you just got a notepad and a highlighter. Whatever your speed is, we are diving in. So let's talk about the first area, the FDA, still open for business as we call it. Something hasn't changed here. We know in biotech that's almost a plot twist with the appointment of Dr. Marty Makary as the new FDA commissioner. Investors brace for turbulence, think delays, mixed signals, guidance rewrites, but so far, crickets. Crickets. Companies like Ocular Therapeutics, Xenon Pharmaceuticals have told us on their business updates that things are, business as usual. The Ocular Therapeutics CEO said it best: absolutely nothing has changed. The FDA has been absolutely consistent. In spite of all of the strum and drang that we're hearing from the media about changes to the FDA, the companies, the people on the ground who are working with the FDA in terms of moving drugs along or getting drugs approved, they're indicating over and over again that nothing has changed. The FDA has been absolutely consistent. That's good news for trial sponsors and investigators. No regulatory whiplash, just good old-fashioned scrutiny, especially around trial design and masking. Sorry, sham arms. The FDA still doesn't think you're real masking. So there's some, behind the scenes things going on at the FDA. But again, like most of the companies that we looked at that reported or gave business updates in the first quarter calls, most said it's basically business as usual. So, for example, even a company like Replimune, which is heading into a big PDUFA decision for its cancer drug RP1, said the process has been smooth with inspections and meetings proceeding on time. A company like Novavax that just got its vaccine approved also indicated the same thing. The FDA had asked for basically a data update, which the company provided. Then it got approval after that. But the company indicated that really nothing had changed in terms of the interaction with the FDA as historically it had been used to. So yes, the FDA does have new leadership, but for now, the policies and the pressure remain predictably familiar. Segment 2, let's talk about the next section. Biotech shorts are in fashion again. Biotech shorts, especially in this cold weather, seem to be the thing to do right now in our industry. Short interest in biotech is spiking. We indicated that in a Biotech Capital Compass newsletter we published just about a week ago. And if you're sort of new to the game, short interest is kind of like the sector's mood ring. And right now, it's glowing deep red. Let me throw some numbers at you. The XBI, the ETF full of small to mid-cap biotechs, just hit an all-time high in short interest, 72.7 million shares. I believe the Wall Street Journal just published an article today on that also. It's one of the most highly shorted ETFs out there. The IBB, the large cap counterpart, isn't far behind, clocking in with a 7x short interest ratio. And both have an S3 squeeze risk score above 70. This is a company, S3, that gives short squeeze risk scores, mostly available on Bloomberg. You can also get it directly from this company. You have to pay for it. But these risk scores for the IB is about 70. For the XBI is, I think, about 83. 100 is the max you can get to. So the translation, a lot of hedge funds are betting biotech stocks will fall. Historically, though, that's often biotech surprises to the upside. That's been historically the case in the many years, a couple of decades I've been working on Wall Street and biotech. Think of it like a beach ball being held underwater. If anything, an M&A deal, a strong clinical trial, even macro rotation sparks sentiment, the beach ball might pop. Why now? Well, we're heading into a catalyst season. Names like ASCO, it's a clinical oncology conference that's going on, ADA, diabetes, Bio International, all the next few weeks, and the sector is still digesting first quarter earnings, which, by the way, historically are the weakest. The second quarter, which will happen in mid to late July and then early August, and then the third quarter earnings, mid to late October and early November, are the strongest for biotech so far. So again, just great for clinical and regulatory catalysts, and again, a very strong second and third quarter revenue and earnings season. We also have some interest rate jitters, which our sector historically does not respond well to, and some geopolitical noise. So here are the takeaways. The setup is tense. The potential energy is high. And as always in biotech, the rallies tend to be fundamentals option right now, very sentiment driven. So again, what we've been saying, you've got to approach our sector very tactically. Look at stocks that you really love. Maybe not fall in love with the sector, meaning on the ETF as a whole, but maybe kind of keep an eye out tactically when it is a good time to invest in biotech. Let's talk about the International Reference Pricing System. We say it's back, also called the most favored nation pricing methodology. And this is basically a blast from the past. This was talked about in 2016 and 17. Again, the International Reference Pricing, IRP, most favored nation, I'll call MFN, drug pricing models. Well, they're kind of like back, kind of like cargo pants and vinyl records, only less stylish and way more terrifying for drug developers. This has been a sort of a boogeyman for our industry on and off. And it was first proposed in 2018 by the Trump administration. The IRP aimed to cap US drug prices based on pricing in other countries. In 2020, it was rebranded as the MFN model. Now in 2025, it's once again on the political radar, thanks to President Trump's renewed focus on Medicare spending. Here's the thing. The implementation of the IRP has always been murky, but the sentiment impact is real. Back in 2018, biopharma stocks underperformed after the initial proposal, as they kind of did right now. Same in 2020. And then now we're seeing that policy overhang creep back into investor conversations. Companies with high Medicare exposure or premium price therapy should stay alert. Investors, keep an eye out on political headlines, especially heading into, elections, which for us will be next year in 2026 or again in 2028. But again, right now we're heading into basically a strong clinical and regulatory part of the biotech investing calendar with medical conferences, and then the second and third quarter earnings season, which tends to be actually very strong for biotech companies that are profitable or have revenues and earnings. What's the good news? Most management teams today are far more tactically prepared for the IRP or MFN, with US-based infrastructure, conservative pricing strategies, and policy playbooks already in place. We published a newsletter previously indicating about how biotech companies that are commercial have at least 60, 70% of their revenues in the United States, some of them 100%. Companies like United Therapeutics, to a lesser extent Regeneron, even companies like Amgen or Gilead, which are more diversified, have 60, 70% of their revenues in the United States. And most of their manufacturing, almost all their manufacturers in the US, A lot of their jobs are in the U.S. Very little exposure to the U.S. dollar and its the vagaries of its movements against other currencies. So, in fact, if anything, tariffs should be good for biotech investing because our exposure is unlike most of the industries. Vastly, we're exposed to the U.S. economy. So to recap, the FDA isn't rocking the boat, which is a win in this environment. Short sellers may be setting biotech up for a surprise rally. And then the IRP is back on the map, so watch out for headlines that might shift sentiment. As always, biotech is not for the faint of heart. It's always one of those few sectors where bad vibes can flip overnight. Just one clinical readout, one acquisition, or one policy change away from a bull stampede or a bear retreat. So again, it is not for the faint of heart, but again, a sector that can really be interesting and something where people who like to get passionate about things. We talked about biotech investing being like poker. If you like probabilities-based outcomes investing, biotech should be something that you should be taking a look at. So again, this is Hartaj Singh. Thanks for tuning into the Biotech Capital Compass. Subscribe if you haven't already. Don't forget to leave a comment or question. We love hearing from you. Until next time, stay curious, stay patient. Don't short biotech without a good exit plan. Take care. Have a good day. Sending the best out to everybody wherever you are.